Good morning, and welcome to the Bulls, Bears, and the Bell Morning Edition.
Thanks for joining us.
We're diving deep today into, well, a really fascinating setup for the week of October 20th, 2025. It feels unique.
It really is. You've got this surge of optimism. Markets are green across the board, almost like everyone's convinced the worst is over.
Right. But the catch is the really big risks, the hard data points that could just completely derail this whole thing, they're all packed into the end of the week, primarily Friday morning.
That's the core tension, isn't it? It's this collision course. You've got positive sentiment now driven by, let's call them soft catalysts.
Okay.
But that feeling is heading straight for the ultimate economic reality check, the truth teller, as you might say, Friday's CPI report.
So our mission today, our deep dive, is really to pull apart those critical drivers for the week. We need to look at everything from the global mood and some pretty wild pre-market stock action.
All the way through to how those Q3 earnings reports are going to stack up against that huge macro data point looming on Friday. It's a complex picture.
It really is. It's like the market gave itself a hall pass to rally early, but that pass expires the second those inflation numbers hit the tape.
Precisely, which means every move, every percentage gain we see Monday, Tuesday, Wednesday, you have to view it as provisional. It's potentially very vulnerable.
Okay, so let's start with that immediate picture, the foundation. What are the futures telling us right now?
Well, the signal is undeniably green this morning, and crucially, it's broad. It's not just one sector or one region.
Okay.
In the U.S., you're looking at E-mini S&P 500 futures solidly higher, somewhere in the plus 0.4% to plus 0.5% range.
Pretty decent.
Yeah, and the NASDAQ 100, the tech futures, also robust,
Yeah.
up about 0.5%, maybe a bit more, around plus 0.54%.
Yeah.
Shows a real appetite for risk this morning.
And you said it's global, so this isn't just a U.S. story.
Not at all. It's synchronized.
Yeah.
Look across the Atlantic. European markets are right there with us. Germany's DAX futures, for example, trading up over 1%.
Wow, okay. So where did this positive energy really come from? Did it start overnight?
It did. The momentum really got going in Asia, powerful tailwinds there. Japan's Nikkei 225 absolutely surged, up, 3.37%. That's a huge move.
Massive.
And Hong Kong's Hang Seng also climbed strongly, up about 2.4%. These weren't small moves. They were high-volume rallies. Suggests there was a lot of pent-up demand, maybe cash on the sidelines getting put to work, a significant repricing of risk over there.
So we have this really palpable sense of relief, almost optimism starting the week. What are the immediate triggers? What kicked this off?
Seems like a bit of a 1-2 punch from overnight news. First, China released its latest GDP figures.
Ah, right. Always important.
And they actually beat analyst forecasts. Now, it doesn't mean China's economy is booming, but it did help ease some of those persistent worries about a global slowdown, especially a hard landing there.
So it took the worst case scenario off the table, maybe.
Exactly. Expectations were pretty low, so beating them provided a kind of global exhale. The second factor is more subtle. It's the market's interpretation of recent rhetoric around some key international trade disputes.
Okay, what about it?
The feeling seems to be that the tone softens slightly, a perception maybe that we're less likely to see immediate new tariffs or escalating conflicts.
So better than feared China data, plus maybe a slight de-escalation on the trade front. Put those together.
And you get a pretty significant tailwind for global sentiment just propagated across markets.
And we can see this reflected in volatility measures too, right? Like the VIX.
Yeah, good point. Let's look at the VIX, the CBOE Volatility Index, often called the fear gauge. It's trading around 20.40 this morning. Now, that's down about 1.7%, maybe a touch more.
So a decrease in expected volatility.
A modest decrease. And the level, 20.40, is key. It tells you there's still some anxiety out there. You know, real panic usually kicks in when the VIX gets above 30.
Okay.
So this drop suggests some cautious relief. Investors are maybe paying a little less for protection, for downside hedges, but they haven't exactly thrown caution to the wind. They're buying, maybe because they think they see things improving slightly.
But they haven't forgotten. Friday's CPI report is still out there.
Precisely. And that brings us right back to the core vulnerability. You used the word fragility earlier. Why are we so skeptical about this rally if the data looks okay for now and futures are up?
Yeah, why the caution?
Because of the nature of those catalysts. They're soft, right? Political talk, interpretations of rhetoric, a single data point from China, even if it was better than expected. This isn't a fundamental shift in, say, monetary policy or the broad economic landscape.
Okay.
And the sheer size of this rally, especially overnight in Asia, It strongly suggests that investors came into the week maybe positioned very pessimistically. Lots of uncertainty.
So they were perhaps holding too much cash, bracing for bad news. And when the bad news didn't hit immediately Sunday night or Monday morning, they felt forced to chase the rally. Fear of missing out.
That's likely a big part of it. It feels like a technical rally, a scramble to re-risk assets, not necessarily a deep fundamental reassessment of long-term value based on new solid ground.
And that sensitivity makes it vulnerable.
Extremely vulnerable. History is littered with examples, right? Rallies built purely on sentiment, on hope, they can evaporate in minutes when confronted with hard, contradictory data.
Like a hot CPI print.
Exactly. If that narrative suddenly shifts later this week, maybe inflation comes in hotter than expected, the reversal could be just as sharp, just as violent as this morning's rally. Because the foundation is narrative-driven, not broad or fundamentally durable yet.
So the key takeaway for you, the listener, is really to treat this early optimism with a grain of salt. Understand it's built on potentially shaky ground.
And it could all be undone by that hard macro data coming Friday. Don't get complacent based on Monday's green screen.
Okay, let's pivot now from that big macro picture to the micro level.
Right.
Because the action in individual stocks before the market even opens is, frankly, incredible this morning. It paints a really surgical picture of where capital is flowing.
Yeah, it's fascinating. We're seeing what you could call a quality bifurcation. The market isn't just buying everything, it's being incredibly selective.
Meticulous discrimination.
Right. Creating these extreme winners and losers. It's like capital is aggressively hunting for verifiable corporate success and just as aggressively punishing operational or governance failures ruthlessly.
It's definitely not a rising tide lifts all boats situation then.
Oh.
Very specific. Let's start with the winners. Where's the money going?
Well, the absolute headline grabber is Rani Therapeutics, ticker RNNI.
Okay.
It exploded pre-market, up an astonishing 248%, maybe even more now, on heavy volume too.
248%. That's transformative. What on earth happened there? It has to be major news.
Oh, it's huge. A
Yeah.
dual-pronged catalyst hitting two critical aspects for a biotech company like this.
All right, break it down. What's the first prong? And maybe just quickly remind us what Ronnie does.
Sure. So RNI's core tech is the Ranapil. It's basically a robotic pill designed to deliver drugs like biologics or peptides, things normally given by injection orally. The pill travels through the stomach and then injects the drug directly into the intestinal wall.
Okay, so replacing needles with a pill. The big question was always, could they get validation from a major pharmaceutical partner?
And the answer this morning is a resounding yes. That's the first catalyst. They announced a landmark collaboration deal with Chugai Pharmaceutical, a big Japanese drug maker.
Wow.
The deal includes a $10 million upfront payment, which is significant immediate cash, but the potential total value could exceed $1 billion through future milestones and royalties.
That's massive validation. It essentially de-risks the technology platform itself, doesn't it? A major player is putting serious money behind the Ranapil.
Precisely. It validates the science, validates the platform, but that's only half the story. The second catalyst is just as important.
Okay, what's prong two?
Concurrent with the Chugai deal, they announced an oversubscribed $60.3 million private placement financing, led by well-known life sciences investors.
$60 million. So the collaboration validates the tech.
And the financing de-risks the balance sheet. It secures their funding, extends their cash runway significantly, pushing out any risk of needing more money or potential insolvency well into 2028, apparently.
So you remove the technology risk and the financial risk simultaneously.
You got it. The two biggest near-term existential threats for a company like this, and the market's reaction. A massive, immediate repricing, over 200% gain. That's the reward for credible, strategic execution.
Incredible story. We also saw another biotech, biotherapeutics, ARTV, surging, up over 120%.
Yeah, ARTV up significantly, plus 127.80% last I checked. That kind of huge jump in biotech almost always points to what we call a binary event.
Yeah.
Meaning something with a clear yes-no outcome happened. Usually positive clinical trial data, maybe phase 2 or phase 3 results came in much better than expected, or perhaps a key regulatory approval from the FDA.
Yeah.
Something that instantly resolves a major uncertainty and forces a complete revaluation of the company's future prospects.
Okay, makes sense. Now there's another big gainer that looks different. Beyond Meat, BYND, up huge, like 64%. But where's the news?
That's the interesting one, isn't it? BYND showing a massive gain, plus 64.19% on really high volume too. But as you said, apparently without a clear, fresh news catalyst, no earnings report, no big deal announcement that we can see.
So if we're talking about this quality bifurcation, where capital is rewarding verifiable success like RNIs, what explains BYND? There's a disconnect from fundamentals here.
There absolutely is. And while you can never be 100% certain without seeing detailed flow data, given BYND's history.
The battleground stock always has been.
Exactly. High volatility and notoriously high short interest. A very large percentage of its available shares are often held by short sellers, betting the price will go down.
So you suspect a short squeeze?
The probability leans heavily that way. It points towards non-fundamental trading dynamics. Any little bit of positive momentum, maybe even just the overall market lifting, can trigger a cascade of short covering. Shorts get squeezed, forced to buy back shares to limit their losses, which drives the price up further, forcing more shorts to cover.
A classic squeeze spiral.
Right.
So less about rewarding strategic success and more about market mechanics and maybe even social media buzz, given its past.
Very likely. It feels more like temporary speculative froth, not the market-rewarding, verifiable, strategic value like it did with RNA. It highlights that the market will latch onto narrative or technicals when concrete news is absent, but the biggest rewards are reserved for that verifiable quality.
Okay, that makes sense. Now let's flip the coin. The bifurcation means there are also big losers. Where is capital fleeing from? What earns the punishment?
And the punishment is just as swift and severe as the rewards. Take Flex Shopper, ticker FPAY.
Right, saw that one. Plunging, down almost 30%.
Yeah, negative 28.37%. And the catalyst here is unambiguous. It's about as bad as it gets from a governance perspective.
What happened?
They received a formal delisting notice from the Nasdaq Stock Exchange
Ouch, why?
for failure to file their required financial reports on time, their 2024 annual report, and their quarterly reports for Q1 and Q2 of 2025. Just didn't file them. That's a cardinal sin in public market.
Absolutely, you have to file your reports.
Uh-huh.
And the killer detail.
The killer detail is that the company came out and announced it does not intend to appeal the delisting decision.
Wow, they're not even going to fight it. That's telling.
It screams deep, deep trouble, possibly irreparable turmoil inside the company. For a smaller company like this, losing your Nasdaq listing, the liquidity that provides, it's often catastrophic. They're also apparently dealing with a notice of default on a loan and a mass exodus of senior management.
So it's not just a missed deadline. It sounds like a complete systemic governance collapse.
That's exactly what it looks like. And the market's verdict is immediate and absolute. No patience for that kind of failure, especially not in this environment.
And then there's an even bigger collapse. Mingzhu Logistics, YGMZ, down almost 80%.
Yeah, YGMZ down a catastrophic negative 88.63%. This looks less like a reaction to brand new news and more like capitulation.
Capitulation.
Maybe.
The final stage of selling, where the remaining investors just throw in the towel. They sell at any price, crystallizing huge losses because they've completely lost all faith in the company's future.
What's the history there?
It's been trouble for a while. A history of operational issues. They already faced a delisting notice earlier in the year for failing to meet the minimum share price requirement. Financially, their last report showed a staggering 55% drop in revenue year over year.
So this massive drop today is just the final nail in the coffin, the last believers giving up. It seems that way. The final surrender of capital. And look, there's another one. INVO Fertility, IVF, down sharply too, negative 46.30%. Again, typically signals a major negative event, maybe bad clinical trial news, or a highly dilutive financing round that destroys shareholder value.
Okay, so stepping back from these individual names, the big picture here, the takeaway for you listening,
Is crystal clear. Capital is demanding quality and governance. Full stop. The reward for RNC's credible strategy and de-risking was immense, over 200%. But the punishment for FlexShopper's basic failure to file reports, its delinquency, was immediate and existential.
And this intense scrutiny, this bifurcation, it feels directly linked to that uncertainty hanging over the week, right? The market is trimming the fat, getting rid of the weak links before that potential storm hits on Friday with the CPI report.
Absolutely. It's preparing for potential volatility by doubling down on quality and ruthlessly cutting exposure to anything perceived as weak, poorly managed, or opaque.
Okay, so we've seen the early sentiment, the micro-level drama. Now let's look forward across the rest of the week's macroeconomic calendar. Because as we've said, the really critical data is heavily backloaded.
Right. This creates this strategic structure for the week. Early moves feel provisional, highly susceptible to being revised, even violently, later on. Investors have to navigate earnings reports first, but always with an eye towards the big data drops coming later.
So what should we be watching today, Monday?
Later this morning, 10:00 a.m. Eastern Time, we get the U.S. Conference Board's leading economic index, the LEI, for September.
Why is the LEI important?
Because unlike GDP, which tells you where the economy was, the LEI tries to look ahead. It aggregates several indicators to predict economic activity roughly 6 to 9 months out. It gives a forward-looking perspective.
Is it dips sharply?
If the LEI shows a significant decline, it could reignite some of those recession fears that maybe got temporarily pushed aside by that better-than-expected China GDP number. It would suggest the Fed's rate hikes are really starting to bite and slow things down.
Okay, LEI today, then Tuesday.
Tuesday, the inflation focus shifts outside the U.S. for a moment. We get Canada's Consumer Price Index, their CPI for September, at 12:30 p.m. Eastern. It's a key read on inflation in another major G7 economy.
But maybe more important on Tuesday are the central bankers speaking.
Definitely. The market will be hanging on every word from people like Federal Reserve Governor Christopher Waller and European Central Bank President Christine Lagarde. They're both scheduled to speak.
And we're not expecting policy changes in these speeches, right? It's more about the tone.
Exactly. It's about nuance, subtle shifts in language. Waller, for instance, is generally seen as being on the more hawkish side of the Fed, more concerned about inflation.
Right.
So if he even slightly acknowledges that maybe the labor market is cooling faster or that inflation expectations seem stable, the market could interpret that as a tiny dovish signal, a green light perhaps.
And Lagarde.
If she sounds more worried about persistent core inflation in Europe, maybe highlighting services inflation sticking around, that could send a more negative signal globally. It underscores how tough this disinflation fight is everywhere.
Okay, speeches Tuesday, then Thursday looks like the first really big data day.
Thursday, October 23rd, is arguably the first major hard data test before Friday's CPI. We get a whole wave of preliminary or flash purchasing managers index data, PMIs, for both manufacturing and services sectors, and crucially, across multiple key regions, Germany, the broader Eurozone, and the U.S.
And why are PMIs so vital?
Because they are incredibly timely. They're based on surveys of purchasing managers about what's happening right now in their businesses, new orders, production levels, hiring, delivery times. They give you a real-time pulse check.
And the key number is 50.
Right. A reading above 50 generally indicates expansion in the sector. Below 50 signals contraction. So if these flash PMIs come in strong, it might support that hot economy scenario we'll talk about later. Growth is holding up.
But if they're weak, below 50.
Then it confirms monetary policy is really restricting activity, validates those stagflation fears perhaps, and increases pressure on central banks to maybe ease off tightening. We also get U.S. initial jobless claims on Thursday, the weekly check on the labor market's health.
Okay, lots happening Thursday. But it all feels like a warm-up act for the main event.
Absolutely. Everything, the sentiment, the earnings, the PMIs, it all builds towards the gravitational center of the week. Friday, October 24th, 8:30 a.m. Eastern Time.
The release of the U.S. Consumer Price Index, CPI for September.
This is it, the ultimate truth teller. This number will shape the narrative for weeks, maybe months.
What's the market expecting? What's the consensus?
Consensus forecasts are centering around core CPI that's excluding volatile food and energy coming in at plus 0.3% for the month over month.
Okay, 0.3. And the headline number.
Headline CPI, the year-over-year number everyone quotes, is expected around 2.9%. That would be a slight moderation from the 3.1% we saw previously.
So the market seems to have priced in a relatively orderly report. Continued gradual cooling of inflation, but nothing too dramatic.
Exactly. Which sets up the potential for a big reaction if we get a surprise. The significance here really can't be overstated.
Why? What makes it the truth teller?
Because any significant deviation from that consensus, whether it's hotter, showing inflation reaccelerating, or much cooler, suggesting a faster drop, will directly and immediately impact expectations for what the Federal Reserve does next with interest rates.
It dictates Fed policy, basically.
It dictates the market's perception of future Fed policy, which is what drives asset prices. The outcome shapes the direction for the rest of this quarter, maybe even into next year. If core CPI prints, say, plus 0.4%, or, heaven forbid, plus 0.5%, that throws the Fed's whole plan into doubt. The market would instantly price in more rate hikes, or rates staying higher for much, much longer.
And it can invalidate everything that happened earlier in the week.
Completely. It has this unique power to retroactively validate or completely unwind all the market moves from Monday through Thursday. If, say, Netflix pops 10% after its earnings on Tuesday,
Right.
but then CPI comes in really hot on Friday, that Netflix rally could just vanish in seconds. Because the fear of rising interest rates, the rising cost of capital would just overwhelm any company-specific good news. Everything hinges on Friday morning.
So, while that macro calendar, culminating in CPI, dictates the overall risk level for the week, we also have Q3 earnings season really kicking into high gear. This gives us that crucial bottom-up view.
Exactly. It's the corporate health check. We get to see how individual companies are actually navigating this complex environment. And crucially, we need to listen very carefully to their forward guidance.
Right. It's less about the quarter they just finished, Q3, and more about what they're forecasting for Q4 and even into 2026. That guidance is where the real battles will be fought this earnings season.
Absolutely. What does the future look like according to the people actually running these businesses? Tuesday, October 21st, is a huge day for earnings. Blockbuster Tuesday.
Kicks off with some big names.
After the market closes Tuesday, all eyes will be on Netflix and FLX. The focus there has really shifted. It's not just about pure subscriber growth anymore.
What's the key metric now?
The market needs hard data on how that newer ad-supported subscription tier is performing. Is it actually profitable? What's the average revenue per user, the ARPU, for those ad tier subs?
And is it bringing in truly new subscribers or just causing existing premium members to trade down?
That's the critical question. Is it additive revenue or just cannibalization? If the economics of the ad tier looks solid, it confirms a potentially huge, more resilient long-term revenue stream for them, justifying maybe a higher valuation. We also need to hear about their content spending plans. That's always key for their future cash flow.
Okay, Netflix after the bell Tuesday. What about before the market opens?
Before the bell Tuesday, we get a couple of major Dow Jones components. Coca-Cola, KO reports.
Always a good global barometer.
Absolutely. KO gives us a vital read on global consumer resilience. In this environment with higher costs, the big question is, can Coke keep raising prices, maintain its pricing power without seeing people buy significantly less? Are volumes holding up?
That's the classic test of brand loyalty, isn't it? If they can push price and still sell roughly the same amount of product, it suggests their brand is incredibly strong and maybe the consumer isn't completely tapped out yet.
Exactly. But if volumes are stalling or falling even as they raised prices, it's a clear signal that the inflationary squeeze is really starting to bite into basic consumer behavior worldwide. Also reporting Tuesday morning is General Motors, GM.
Okay, what's the focus for GM?
Insights into the overall auto market, obviously, but specifically how their EV production ramp-up is going. Are they hitting targets? And critically, how are they managing labor costs, especially after recent union negotiations? That's a big headwind for them.
Got it. So Tuesday is Netflix, Coke, GM, then Wednesday. Looks like Megatech takes center stage.
Wednesday is huge, dominated by Tesla, TSLA, reporting after the close. And with Tesla, you have to be surgical. Look way beyond just the headline vehicle delivery number for Q3.
What are the critical details then?
Number one is their forecast for Q4 deliveries. What visibility do they actually have into near-term demand? That's crucial. But even more critical, you have to dig into the trend for their automotive gross margins, excluding the regulatory credits.
Right, you mentioned this before. Why is excluding the credits so important?
Because those credits, which Tesla sells to other car makers who need help meeting emissions rules, are essentially pure profit. They're not related to the efficiency or cost of actually building and selling cars. They can mask underlying issues.
So the X credits margin tells you the real health of the core manufacturing business.
Precisely. If that X credits margin keeps falling, it strongly suggests their strategy of cutting prices aggressively might be structurally damaging their profitability. That could force the market to really question its high-growth tech stock valuation multiple.
Makes sense. What else for Tesla?
We'll also be looking for any real substantive updates on full self-driving FSD adoption rates. Are people actually paying for it? And progress on the Cybertruck ramp-up. Both are potential volatility drivers for the stock.
And earlier on Wednesday.
Before Tesla, we get AT&T in the morning and IBM after the close. These give us important reads on different areas: AT&T on the telecom landscape, wireless competition, subscriber trends. IBM is key for enterprise IT spending.
How so?
If IBM's consulting and software revenues, especially around AI and hybrid cloud, are holding up or accelerating, it suggests that big companies are still willing to invest heavily in technology and digital transformation projects, despite the macro uncertainty. That's a positive sign for underlying business confidence.
Okay, that's a good indicator. Then Thursday, the focus shifts again.
Thursday brings an industrial and semiconductor check. After the close, Ford Motor Company F reports.
Direct comparison to Tesla then.
Exactly, head to head. The focus for Ford will be intense scrutiny on the profitability challenges in their EV division, Model E. How much money is it losing? And can the profits from their traditional truck and SUV business, the ICE side, continue to fund that very expensive AV transition?
A tale of two companies within one company.
Pretty much. And then also after the close Thursday is Intel, INTC. Intel is always a crucial barometer for the entire semiconductor industry and, by extension, a lot of the tech economy.
What are the key areas for Intel?
We need to see if demand in the data center market is recovering. That's been a weak spot. And what's the outlook for the broader personal computer PC market? If both of those remain depressed, it signals persistent weakness across key tech demand verticals.
Okay, a lot riding on Thursday's reports too. And then we get to Friday morning.
And the timing on Friday is just strategically perfect, or perhaps perfectly cruel, depending on your positions.
Why? What happens Friday morning?
Procter & Gamble, PG, reports earnings before the market opens. P&G, the consumer staples, Giant Tide, Pampers, Crest, all those brands.
And they report when?
They report at 7:30 a.m. Eastern Time, just 1 hour after that critical CPI inflation data is released at 8:30 a.m.
Oh, wow. So the macro and micro collide with maximum force right there.
Exactly. P&G is arguably one of the best indicators of global consumer health and brand loyalty. Their management commentary on the earnings call, happening right after the CPI print, will be under an intense microscope.
What specifically will people listen for?
Pricing power versus volume growth. Did they raise prices again? Almost certainly. But what happened to the volume of stuff they sold? Did people buy fewer bottles of Tide or packs of diapers because they got too expensive?
So it provides immediate real-world context for the inflation numbers we just saw an hour earlier.
Precisely. Let's say CTI comes in hot, higher than expected. And then an hour later, P&G reports that their volumes actually declined even as they raised prices.
That would be powerful confirmation.
Devastatingly powerful. It would confirm in real time from one of the world's biggest consumer companies that high inflation is unequivocally eroding purchasing power. It would mean consumers are finally buckling, trading down to cheaper store brands, delaying purchases. That validates the stagflation threat right there. The market will react instantly to that combination.
Okay, so pulling this all together, the strategic landscape for this week is really about navigating this collision. Macro forces, primarily CPI, hitting head-on with micro forces, the earnings reports, and especially their guidance. And all of it layered on top of this fragile early week sentiment.
That's the challenge. Any conviction you might feel based on Monday's rally needs to be seriously tempered by that huge event risk looming on Friday. You absolutely need to be thinking about the different ways this could play out. Scenario planning is key.
All right, let's game that out. What are the main potential scenarios based on how that crucial CPI number and maybe Thursday's PMI data come in? These seem like they'll define the market's tone for a while.
I think you can break it down into 3 main possibilities. Scenario 1, let's call it the Goldilocks scenario. This is the best case, the unambiguously risk-on outcome.
Goldilocks, not too hot, not too cold. What does that look like in terms of data?
That means CPI meets or maybe even slightly beats expectations. Inflation is clearly easing, maybe core CPI prints plus 0.2% month over month, showing deceleration. And this happens alongside PMI data that's resilient, maybe stable or slightly above 50, showing economic growth is holding up okay, not collapsing.
So inflation cooling without cratering the economy, the soft landing.
Exactly. The soft landing narrative gets validated. The outcome, you'd likely see a broad, sustained market rally. Those early week gains get confirmed. Companies that reported strong earnings, like maybe Netflix or Tesla if they deliver, would likely see strong follow-through. A much more durable foundation would be set for the rest of the quarter. That's what the bulls are desperately hoping for.
Okay, Goldilocks is the dream. What's the nightmare? Scenario 2.
Scenario 2, the stagflation scenario. This is the most negative, the clear risk-off environment.
Stagflation. Stagnant growth plus high inflation. What data triggers this?
This is where CPI comes in hotter than expected. Inflation proves sticky, maybe core CPI hits plus 0.4% or worse, showing reacceleration. And this is coupled with weak PMI data, maybe falling further below 50, signaling that economic activity is slowing down significantly.
Ugh. So the Fed is forced to keep hiking rates or keep them high, even as the economy weakens.
That's the nightmare. It's a devastating combination for almost all asset prices.
Yeah.
The outcome would likely be a significant, sharp sell-off across the board. Macroeconomic fears would completely dominate everything.
So even if a company reported great earnings earlier in the week,
It wouldn't matter. Doesn't matter how good Intel's or Coke's numbers were, the market would panic about the rising cost of capital hitting a slowing economy. Everything gets sold off.
grim. Okay, what's the third possibility? Is there a middle ground?
Scenario 3, let's call it the hot economy scenario. This one is mixed, probably leads to a lot of volatility and confusion initially.
Hot economy, what does that mean?
This happens if both the CPI data and the PMI data come in stronger, hotter than expected.
Wait, so strong growth and high inflation. Isn't strong growth good?
It is, but the high inflation part is the problem. Think of it like driving a car too fast. You're making progress, strong growth, but the engine is overheating, inflation, forcing the driver, the Federal Reserve, to slam on the brakes harder and faster than expected.
So the market freaks out about more aggressive Fed action.
Exactly. Panic over the necessity of deeper, faster rate hikes to cool things down. The outcome here is uncertain, choppy trading. You'd likely see a sharp sell-off in sectors that are very sensitive to interest rates. Tech stocks get hit because higher rates crush their future earnings valuations. Real estate gets hit because borrowing costs soar.
But maybe some sectors do okay.
Potentially. Cyclical sectors that benefit from strong growth, or sectors seen as inflation hedges, like maybe energy or materials, could hold up better or even rally in that scenario. But overall, it's an environment of heightened uncertainty about the Fed's path.
Okay, Goldilocks, stagflation, hot economy. Three very different potential paths depending on Friday's data. So strategically, how should you, the listener, approach this week given these possibilities?
The main takeaway is that a cautious, tactical approach makes sense. Don't go all in based on Monday's green screen. And maybe your primary filter should be that quality bifurcation theme we saw in the pre-market.
Focus on quality. Why is that the best strategy here?
Because in almost any of those three scenarios, quality tends to hold up better. Companies with strong balance sheets, proven business models, and real pricing power. Think about firms like Coca-Cola or Procter & Gamble we discussed. They are generally better positioned to navigate volatility, whether it comes from inflation fears or growth fears.
They have more resilience.
They do. And pay extra attention to the qualitative forward guidance from the CEOs, especially from companies reporting later in the week after we have more data. What they say about the outlook, their confidence level, that will likely be far more telling than just the backward-looking Q3 numbers.
Because the market is craving clarity.
Desperately. In an environment this uncertain, the market pays a huge premium for reliability, for predictability, for strong governance. That's why quality matters so much right now, precisely because Friday morning remains such a massive unknown. Hashtag tag outro.
So summing it all up, the market has definitely given itself an early boost this week, fueled mostly by hope and maybe some relief on the China front.
Yeah, an initial positive lift. But the true durable direction for the rest of this fourth quarter, that feels like it's going to be decided sometime between Tuesday's opening bell when we start getting those crucial earnings like Netflix.
And Friday morning, probably right after P&G gives its real-world reaction to the CPI numbers, that window seems critical.
Absolutely. And as you track that collision between the macro data and the corporate results, maybe hold on to that theme we discussed earlier, corporate governance.
Right, the Flex Shopper example was stark.
Incredibly stark. The immediate existential penalty they paid just for failing to file basic reports. It raises a really interesting, maybe provocative question for you to think about beyond just this week.
Okay, what's that?
Does this newfound ruthlessness from the market, this intense demand for absolute transparency, for financial credibility, for good governance, does it signal a permanent shift? Is this the new normal?
Meaning governance is no longer just a nice to have, but a non-negotiable premium.
Exactly. If a company like Rani Therapeutics gets rewarded so massively for strategically de-risking its balance sheet and validating its tech credibly, will the market finally apply that same brutal standard consistently to maybe speculative growth companies that have historically relied more on narrative and hype than on solid financials and timely filings?
That's a fascinating question. Has the tolerance for shaky governance finally run out, especially when capital is getting more expensive.
It's something to watch. This focus on credibility, on quality, on governance, it feels like a trend that could reshape how companies are valued and traded long after this particular catalyst-rich week is over.
Definitely something to keep tracking. Monitor that interplay between the rigid macro calendar and the very fluid corporate pulse throughout the week. It promises to be eventful.
It certainly does.
We'll be back to deep dive into the fallout. Thanks for joining us on Bulls, Bears, and the Bell.